So I see we have enough people who have joined, and therefore we wish to start at this point. My name is Michael Orugo. I will be moderating this session for today. We are joined by the best of the best from our PKF Nairobi office, Mr. Alpesh Vanda, who is going to be discussing with us the economic side of the budget. We have Mr. Kevin Chege, who is our senior tax manager. He's going to be dealing with the direct taxes, and Mr. James Moridi, director in tax, who is going to be dealing with indirect taxes. So without much ado, I wish to invite Mr. Alpesh Vanda to commence the first session of today's webinar. Thank you, and enjoy the session.
Thank you, Michael. I think before we start discussing Kenya's economic outlook, I just want to put in a caveat that we are currently living in times of uncertainties. I think there are so many issues globally that are happening that can affect Kenya's economy. And also domestically, we all know what happened yesterday, also what happened last week, which is not good for the image of Kenya. So this could have a huge impact on our economy going forward. So please take this into account as we discuss the slides going forward. Global growth, I think we've grown at about 3.2%, and it's expected that this growth may not continue. We all know what's happening around the world. As I said, we've had too many wars. The Russian-Ukraine war is still continuing. It's in its third or fourth year now. We recently had the Israel-Gaza war as well, which has continued for over a year now. Of course, the Iran war started, and we recently had the Pakistan-India, which we were lucky it didn't escalate too much. And then, of course, we have a new administration in the US bringing in a lot of tariff issues globally and uncertainty as well. And what the World Economic Outlook from the IMF is that it's projecting a lower growth compared to what it had projected earlier and settling at about just below 3%. And key issues, of course, is the tariffs issues, the inflation is coming down, the uncertainty regarding trade because of the tariffs. Because at the end of the day, a lot of economists are saying tariffs basically kill the economies, it slows down growth because everybody is fighting each other. But we are hoping in time to come, in the next 6 to 9 months, things would have settled. Of course, we have geopolitical tensions as well, as I mentioned, too many wars taking place at this moment in time, which is not good for the global economy. And of course, you will have all these differences because everybody is trying to grow their economy and everybody's competitive is quite different. And of course, once you get to the top, you have to really grow, you have to look after your population. And that's really trying to hurt everybody. And that's the main reason why all these tariff situations and geopolitical tensions are taking place throughout the world. Looking again at the global economy, just going back a little bit from after COVID, a lot of funding was distributed in the US, UK, and Europe itself. We are all aware that this economy depends on consumer spending. A lot of money was splashed out, money supply in the market, which caused a lot of inflation. And of course, that action had to be taken by the central banks in the respective jurisdictions to increase interest rates to contain the inflation. The interest rates are on a downward trend because inflation right now is also on a downward trend as well. And we're hoping this will continue in time to come. Again, the key indicator which causes inflation to go up is oil, because a lot of countries depend on oil. And because of the slowdown in the economic growth and global tensions, there is less supply, and less demand. So supply is also slowed down. The prices have come down to about $65.2 to the barrel as of April. It did climb recently when Iran attacked Doha, right? It did go up for a momentarily. But this, we have to keep an eye on this because it has an impact on inflation globally, and it also affects us because we import a lot of oil. Global outlook, as I said, hopefully if things are the way they are, we're expecting inflation globally to go down. We've also seen inflation going down in Kenya as well, and so are the interest rates going down. Again, it's quite stable. Indicators are that, again, because of inflation going down, interest rates have actually even gone down. But interest rates in the US have actually not gone down to that extent because the Fed is looking at the impact of what the tariffs are going to do to the economy. Because the new president wants to make America great again. He wants to make it more productive. He wants to try and protect the local industries. So majority of the imports which are coming through are going to be heavily taxed, and a lot of tariffs will come through. Prices again will rise. That would cause inflation. So the Fed has been very, very cautious in raising interest rates. They want to see what the impact of the tariffs are going to be like. Though there's a lot of pressure from the president on the Fed chairman to reduce the interest rates, but in time to come, we shall see. Nevertheless, the US economy shows strong growth. They added another 140,000 jobs just last month. So the economy is still vibrant and still strong despite tariffs coming through from 1st of July this year. So in time to come, we shall know how the interest rates movements are going to take place. Interest rates in the UK and the US have already been reduced, but the inflation level in the UK is still high, still hovering over the 2% guideline which they have set for themselves. So we shall see in time to come how the inflation is moving going forward. Coming back to Africa, Kenya was again the 7th largest economy as at December 2024. And I think we are happy to report that Kenya is now the 6th largest economy in Africa and the largest economy in East Africa. And there is no reason why, as a country, from a strategic purpose, why we can't target to become the 5th largest in the next couple of years. But of course, there's a lot of work that needs to be done. We can't expect the economy to grow when we have too many mandamanos in the country. Those are additional holidays. We lose out on productivity. People who have borrowed from the banks suffer a lot as well because they can't make any sales and they're going to be charged interest by the banks. So I think we need to really seriously look at this issue and see how we can grow the economy. Again, per capita income, we are not doing badly. We are at number 5. But I think what is important to note is the population. Nigeria is the largest economy in Africa, where the population is almost 238 million people. South Africa is only 64 million, and their GDP is almost 400 billion US dollars. I think it's important to note is this doesn't really indicate that we are doing well, but what is important is the inequity in all these countries. What I believe is South Africa has got unemployment of almost 50%. I think the challenges for Africa and all global economies how to reduce the inequity globally so that the wealth is created for everybody. Because I think the major concern, especially going for the Gen Zs in Kenya, is that we are growing by about 5%, but the growth is not being felt downwards to the 1 NG. So I think that's an area for the government to look into and to see how we can assist the local people. Key economic indicators for Kenya, we are all aware that Kenya is an agro-based economy. So agriculture is going to be the highest contributor to our GDP, followed by transportation, real estate, financial services. So I think there are a lot of good things happening in Kenya. We are, of course, largest exporters of avocados, flowers, tea, coffee. Tourism is also boosting. I think it's important to look at the last column, accommodation and food and service activities, which is growing at a rapid pace. As we speak right now, most of the hotels, hospitality industry is really booming. A lot of investment is taking place in Masai Mara. A lot of new hotels are coming in place. And what is important is big brands are now looking at Kenya very differently. So I think we have a big opportunity in tourism, and that will help to grow the GDP for Kenya in time to come. So I think we need to look at this critically and see what we need to focus, what is our competitive advantage, and focus on that so we can have a faster growth. What is of disappointment? Again, this is a very similar slide to the previous one. Again, the agriculture is expected to grow about 5.2%, non-agriculture by 5.7%. But I think what is disappointing, and I think we've been discussing a lot with CBK governor and also Kenya Association of Manufacturers. I think the key issue is that our growth in manufacturing is extremely low. We release about 800,000 to 1 million graduates from university every year. So I think that the government needs to see how we can employ these people. We don't need to export talent and develop other countries, but that's what's happening currently. I think we need to look at manufacturing critically. There's a lot of concern on competitiveness. Our electricity prices are extremely high. Cost of doing business is extremely high. There's just too much of red tape, whether it's at KPS, whether it's at ports, whether it's at customs, whether it's the taxes. I think we need to look at a number of issues to see how we can streamline and improve our manufacturing so we can create our growth. Again, you can see the accommodation and food services. This is expected to grow by almost 14%. And as I keep on saying that Kenya is a beautiful country. A lot of people are now traveling, especially after COVID. So I think that's an area we can certainly improve. I think, of course, as soon as you land into JKI, I think we need to make sure that we welcome our tourists very well. And our immigration processing is also improved so that we can process our passports and immigration much faster. Monetary developments, just like whatever is happening globally. As I said, Kenya is part and parcel of the global economy. So whatever happens globally impacts us. So as the interest rates are coming down, so are the interest rates coming down in Kenya as well. You can see we had a very turbulent 2024. And in February last year, the dollar, the pound had gone almost over 200. The dollar was hitting almost 170. And we were losing 50 cents on a daily basis. The government did two things. Of course, it refinanced the June 2024 Eurobond because of 2 billion. We got 1.5 billion US dollars. And of course, we issued an infrastructure bond where we gave out a big interest rate of almost 19%. Those two events within a week helped to create trust in the government and manage the situation. And the exchange rate has ever since stabilized. And of course, with the global economic conditions improving and becoming favorable, it has led to interest rates going down. And as we speak, the T-bill rates have now, for the 364 days, have now gone below 10%. The forecast again for inflation, you can see it there in October 2024, where inflation had come down to almost 2.7%. And the CBK's target is to leave it between 2 to 7.5%. And it's expected to remain there for the next couple of years. So I don't expect interest rates to go up so much in the short term, but in the medium term, there will be recent bonds which are being issued, which are holding at between 12 to 13%, which is actually good news for the government because that will be less expense to finance the fiscal deficit. Again, on the domestic economic growth, I think it's important to acknowledge that we are trying to grow at about 10 to 11% on nominal. If we take out inflation of about 5.5%, it's expected to grow at 5.4%. So in 2029, it is projected that our economy will be worth about $26 trillion, which is a good thing. But I think from my perspective is that I think we need to see how we can increase that 11% to about 15%. When you have economies like China and India growing at about 6.5 to 7.5%, I think those are good growth. I think for us, this growth and to sustain our public deficit, I think we need a much higher growth. I'm sure the government is willing to do that, but I think we need to sit down, have a roundtable discussion with the private sector and to see how we can improve our processes, how we can improve our image as a country, how we can bring in efficiency in government, how can we deal with corruption, corruption is a big hindrance to our growth, to ensure that to see how we can take up our growth, our nominal growth from 11% to about 15%. Again, as I mentioned, our tourism, we are getting about 2.4 million international visitors, and this will keep on increasing. But if you look at my next slide, I think we have a big opportunity. From research tells me, as I said, we have 1.5 billion people traveling the world. And I don't think 2.4 million people visiting Kenya is a good enough number. When we look at the international destinations like France and Spain, which are getting over 80 and 100 million people, and those countries are now actually crying in the sense because most of the accommodation is now been converted into Airbnbs. The local people can't afford to buy houses. It's becoming a crisis. They don't want tourists. So does Italy as well. I think it's a big opportunity for Kenya. We also need to be conscious that our neighbors, next door neighbors, Tanzania, are very, very close to us. They're also getting about 2.14 million people as well. We've recently visited Tanzania for a retreat, and we can see the big difference as to why they're getting more tourists compared to others. So I think it's a big opportunity for Kenya. We also need to ask ourselves as to why Morocco and Egypt are getting more than 15 million tourists. So I think it's a big opportunity. I know the Kenya Tourist Board and the government is trying to, the first target is to get about 5 million tourists. So that is basically the double of what we are actually getting. But I think we need to relook at Kenya as a country. But again, as I said, with the events of yesterday and last week, we've been talking to a lot of tourist companies as well. A number of cancellations have already taken place, which is not good news. In this time of social media and social with IT technology, news travels very, very fast. I think the government needs to arrest the situation to see how we can improve on these numbers. But we have a big, big opportunity, and I'm hoping that these numbers will look better in time to come. Monetary developments, again, as I said, interest rates are coming down, so is inflation coming down. And we are hopeful that the CBK will be able to manage the inflation target of between 2.5% to 7.5% in time to come. Current account balance, again, we import more than we export. So we always going to be under pressure in terms of currency. I think the important thing is that we're able to manage the percentage to GDP, which is at about 2.8 in time to come, is 3.3, 3.1% up to February. I think as long as we keep it below 3%, I think we should be able to manage our pricing in terms of exchange rate, and that will be helpful. But I'm hoping in time to come, I think that's been a concern also from the governor of the CBK, that when our currency was depreciating, our exports were not improving, which was a bit of a concern. So again, I think we just need to go back to the drawing board, back to the private sector and ask ourselves, what do we need to do to boost our exports so we don't have a huge currency fluctuation and interest rate fluctuation that we have seen over the last 2 years. But I think it's important to note that for businesses, we need a very, very stable environment. And we are all aware that in 2024, Kenya's currency was the best performing currency. In 2023, we were the worst performing currency. So as a businessman, it's very difficult to predict the outlook. It becomes very, very difficult to predict how to prepare your budgets as well. And especially coming out of COVID, I think we need a very, very stable economic environment. Diaspora remittances, as I mentioned earlier, we are releasing about 800,000 to 1 million graduates. We need to create jobs for this. Kenya's population by the end of 2050 is expected to be about 85 million people. So we need to ask ourselves, how are we going to keep them occupied? We are all aware that global population is slowing down. Population in the Western economic or Western developed nations is slowing down as well. That's why they're recruiting a lot of people from Africa, and especially Kenya. Kenyans are very hardworking, they're highly educated, speak very, very good English. So we are losing talent, which we developed from our taxpayers' money, and they're going and developing the developed nations, which is not a good thing. But I'm hoping this will reverse in time to come. But their contribution should be acknowledged, and they are contributing almost 50 billion to 60 billion shillings a month to Kenya's economy, and that helps with the forex rates as well. Again, the CBK, they are quite comfortable at this moment in time because, of course, of the Eurobond, of course, of high interest rates which were released given last year. A lot of investors had parked their money in foreign deposits, which they've released in time to come. And CBK is sitting with very, very healthy reserves with almost more than 4.44 months of import cover. Normally, they would be happy with 3 months, but they are sitting with 4.44. And I understand in the month of May and June, they even gone more up to $10 billion. So which was the highest ever foreign exchange reserves. So which is quite healthy. And of course, the government will be there to help to make sure that the exchange rate is very, very stable. And again, coming back to the exchange rate, we can see that it's a flat line for the last 8 to 9 months, which is a very, very good sign for the economy. But again, the US dollar has depreciated globally as well. There are, of course, concerns with the recently big, beautiful bill, which has recently been passed by the Senate and the Congress in the US. And of course, that's expected to increase the public debt in the US itself, which is currently sitting at 36 trillion. So that's why we have seen the pound and the euro appreciating against the dollar. And there's a flat line against the dollar itself. Kenya's currency, as I mentioned, has been very, very stable. When we compare this with other international currency, it's just appreciated by, or it's actually appreciated by 0.03%. When we look at the African countries, again, it's very, very stable. We are all aware of what is happening in Tanzania. Tanzania has lost by about 9% to the US dollar. They have recently brought in regulations whereby they want all transactions, all trade transactions to be done in Tanzanian shillings. We are all aware that Tanzania had become or moving more towards a dollarized economy, and they have now tried to reverse this trend to conserve the currency because of the depreciation. So everybody is trying to protect the currency because most African economies, they have got public debt in foreign currency. Any exchange rate movements unfavorably hits the public debt quite significantly. Again, as I mentioned, Trump's big beautiful bill. We've already seen the drift between Elon Musk, who was in the Doge territory. He's recently left government. He's just recently formed his own party on Sunday called the American Party. Again, the concern for him was that by passing this bill, we are increasing the debt. So as we speak, last month, the debt now is at 37 trillion. Reports and research says that the US debt is increasing by 1 trillion every 6 months and is expected to hit 50 trillion in the next 10 years. So there's a lot of concern globally as well as to whether the US economy and whether this debt can be sustained because the interest rate payments are also going high. That the interest on the global bonds as well is almost 5%. So there's a lot of concern. And so you can see a lot of shifts, and there's also a lot of concern, a lot of pressure also on the Fed's chair, as I mentioned earlier, to cut down the rates. And of course, the US has now also lost the AAA rating, they're now AA-B, so which is not good signs. But as we mentioned, that in time to come, we will see how this plays about. And what is more important to note, there is a lot of pressure also from other institutions to join the BRICS. Because most of 60 to 70% of global trade is done by using the US dollar. But at this moment in time, we don't have an alternative currency. So I think we just have to wait and see. But I think it's important as business people to be aware of what's happening internationally. It could have a huge impact on your local businesses. I think coming back to managing government finances, I think with all governments, I think it's managing the right balance. Making sure we collect the tax revenue, how we're going to finance government expenditure, how do we bring in the expenditure, and then of course, how are we going to finance any deficit? And again, it's the same issue everywhere. We are all aware of what's happening in the UK as we speak right now. I was reading again yesterday, there are now talks of introduction of wealth tax. We're all aware what happened in Parliament in the UK last week. They have been because of political reasons, they've been forced to make a big U-turn on expenditure, right? On the financing that they were giving to the disabled people. So they had to make a big U-turn. They were trying to save about £5 billion. But yesterday there was talk now that they may rise or increase tax rates in time to come. There's a talk of wealth, the introduction of 2% of wealth beyond 10 million pounds, which will bring in additional 11 billion pounds worth of revenue. So every economy is trying to do the same. We recently had the privilege to meet the Cabinet Secretary for Treasury in Kenya, Mr. Honorable Badi. And of course, his thinking was a little bit different. He says we need to first see what we can collect realistically, and then we need to see how we can spend realistically. In the past, what we have done is we have gone ahead and made a budget of what we want to spend, and then we can't collect, and then we end up with a huge fiscal deficit. So when we look at this year's budget, there is no major increase in tax revenue. They have just tried to make changes on the VAT side and a few changes from here to there on the custom side as well, on the import side as well. But nothing significant. I think the government has learned from last year as well. If you increase your taxes, that doesn't mean you're going to increase your revenue. I think what we need to now focus is increasing and growing Kenya's economy beyond the 5 to 5.5% to increase our tax revenue. Because what we believe is increasing taxes actually reduces the disposable income for wananchi, And when you reduce the disposable income for wananchi, you spend less. Revenue for the public sector also reduces, profitability reduces, the collection for the government also reduces. So I think it's important that the government finds the right balance so that we can move forward. I think it's important to acknowledge where the 4.2 trillion is going. We're spending almost 1.24 trillion just on interest. Education, which is again important, we are giving free schooling. This was introduced by our late president, Honorable Kibaki, which is about 723 billion. Energy county, which is about 10%, 436 billion. So where are we going to have the development come through? So I think the government needs to really bring in the efficiency. We need to improve our tax collections. We need to bring in efficiency. We need to look into corruption critically, reduce our fiscal deficit so that we can reduce our interest payments, and whatever reduction that we can bring in efficiency that can be utilized to development. The key message to the government is whatever we are spending should help to grow the economy. The growth of 5%, I believe, is not enough with the kind of deficit that we have. Again, this is an important table. We expected to collect about 3.3 trillion with the grants and the appropriation in aid. We expected to spend about 4 trillion, expecting a deficit of about 880 billion. I think what is important to realize there is how we are going to finance. And what the Honorable Secretary said is we want to keep away from the IMF and the World Bank and the Eurobond people, because we have learned that when we have a significant devaluation of the currency, our public debt really increases. Our public debt in foreign currency is 50%, it's almost about 5 trillion. A 10% devaluation of the Kenyan currency hits us with 500 billion. With a 20%, it's almost 1 trillion. So I think he's been very cautious. So he said we are going to borrow domestically rather than going outwards. So you can see the financing has reduced. It's almost about 300 billion from internationally and about 600 billion locally. But I think what is important to note is that interest expense as a percentage of total revenue is almost 33% currently. It's expected to come down to about 25%. And total revenue as a percentage of GDP has come down to about 17%. We are all aware that our economy contracted to about 4.8% from 5.2% in 2023. And this is expected to remain at about 18%. And there's a lot of pressure from IMF and World Bank to increase this from 18% to take it up to about 25% in time to come. But again, I repeat that we cannot really increase the taxes. We need to see how we can grow the economy and improve that percentage as a percentage of GDP. Fiscal performance outlook, we are trying very hard to grow our economy and manage our fiscal deficit. So currently we're sitting at about 5.3, 5.1% of GDP. We expected our fiscal deficit to come down to about 2.7% in time to come. Kenya's debt outlook, going a little bit of history, and I think we have set ourselves a debt target, a debt anchor of about 55%. That is, again, if our economy improves, if we bring in efficiency, if we are able to manage our fiscal deficit percentage to GDP, we should be able to get to a debt anchor of 55% by 2029. Again, you can see the big difference. We are moving more towards our domestic borrowing compared to external borrowing, and you can see that gap widening. But I'm hoping in time to come, of course, we are in discussions with the World Bank and IMF of certain projects and to see how this is going to move in time to come. So I think there's a lot of focus on managing our public debt. We don't have a situation of what Ghana went through, or what Sri Lanka went through, or what Greece went through, or what Italy is going through, or what Japan is going through. So I think this is a good strategic decision which the government has made. But again, as I repeat, we just need to make sure that we have efficiency in government. Again, just going by a little bit of history, our debt anchor used to be in our retired President Uhuru's time at about 50%. We changed that to a ceiling. We got to 9 trillion, then we went to 10 trillion, then we went back to a debt anchor of 55%, I think, which is a good indicator of how we should be moving forward. And as I mentioned earlier, you could see that the debt in foreign currency reduced in February 2024. because we refinanced our Eurobond and we issued an infrastructure bond and gave out an at interest rates of 18.46%. That really helped us to reduce our public debt and brought in trust and confidence that the government would be able to pay our debt in time to come. Our debt component, these are basically how we are going to, how the countries and the bilaterals debts that we owe. We owed about 5 trillion. This is as at June 2024 last year. And then you can see that the Chinese are the biggest lenders to us. Of course, we have a lot of multilateral debts as well, IFAD and EEC and Industrial Development Bank and IMF. So everybody is supporting our country, but we have to one day pay off this debt in time to come. And we don't have a situation that the Gen Zs have to pay a lot of debt in time to come because of inefficiencies of the government. So again, it's all about efficiency, controlling our corruption, improving our growth to make sure that we don't. Again, there's a little bit of research from IMF. I think it's an Africa problem. I think for the developed nations, the interest rates are in their favor. We have to, because of trust and confidence issues for Africa, our rates are much higher compared to the developed nations. And you find most countries face high debt burdens, especially in Africa. You can see similar situations in Asia and Latin America and the Caribbean. So I think we need to all get together and to see how we can improve Africa's governance and how we can develop our economies and grow our economies much faster. I think the question that we need to ask ourselves is that Africa is the strongest economy. We're going to be 2.5 billion people by 2050. I think it's the richest economy or with lots of minerals and wealth, but we are the poorest. I think it's just a question of governance, and we need to get our act together and to see how we can really improve. Again, it's the same. I think the concern here is basically interest payments, which is doubling relative to revenues. And again, we have to give high interest rates so that people can invest with the government and so that the government can be able to continue running in. So again, this message is very clear. Africa needs to really improve and to see how we can grow our economies much faster. I think also what is of concern is we've got 3.3 billion people globally, where we are spending more on interest than spending more on education and health. So I think we need to really focus on seeing how we can bring in efficiency, how we can bring in confidence, how we can bring in foreign direct investments to Africa, how we can create employment so that people can pay taxes, how we can retain people and retain talent in Africa to grow our economies. So Africa is a big challenge. So Kenya is doing fine. We are now the 6th largest. But as I said, we should be a target strategically to see how we can become the 5th largest in time to come. Thank you for listening to me, and I will hand over to Kevin to take over to income tax. So, thanks.
Yeah, just before Kevin starts, I really wish to thank Alpesh for a very good presentation. No one could have done it better than you have, Alpesh, so well done. So at the end of this session, we'll have a chance to respond to a few of your questions. So if you have any question, you can post it on the Q&A tab, and we are going to try as much as possible to respond to the questions that come through within the time that we have. So over to you, Kevin.
Thank you, Michael. And as you have said, very huge thanks to Alpesh for taking us through that session. So I'll take us through the changes that have come in through the Finance Act 2025. I remember the last time we had this conversation, we were talking about them being proposals in the Finance Bill 2025. Now, they are no longer proposals, but we are talking about changes that have already been enacted into law. So what we'll be looking at in the next session and in the next subsequent slides is what has already become law. And what you need to note is that most of these changes have already become into effect from the 1st of July 2025. And those that will come into effect later will come into effect on 1st of January 2025. But we'll talk about them as we proceed. Now, without further ado, we look at the changes that have come in through the Income Tax Act by the Finance Act 2025. Just a few cleanups, I'll call them cleanups on the definitions, which are covered under Section 2 of the Income Tax Act, there is a definition on introduction of withdrawals, which substitutes winning for purposes of gaming and betting purposes. And there is also a harmonization of the definition of related persons so that there are no two different definitions of related persons. Remember, related persons is important for purposes of transfer pricing purposes as well as for purposes of capital gains tax. Moving on, there was a change from 2023 where we substituted digital service tax to what we call significant economic presence tax. There has been now a further change to that, where the issue of significant economic presence tax has been expanded to cover any transactions over the internet or a digital marketplace. And what came out through the public participation is that there needs to be some regulations to cover significant economic presence tax, and those will be issued within 6 months from 1st of July. Another change that has come in is that the timeline for change of year-end application has been reduced from 6 months to the new year-end to 3 months, and applications shall be deemed to be approved if the commissioner does not respond within that period of 3 months. There is also an expanded definition of or scope of withholding income tax to cover any digital marketplace facilitation transactions, as well as what we have talked about earlier on withdrawals from betting and gaming will be subject to withholding income tax at the rate of 5%. There is also a change that has come in to incentivize maybe the Kenya Airways or the national carrier, where the national carrier pays payment to non-residents for specialized services that cannot be available locally, that will not be subject to withholding tax. Maybe just to incentivize the national carrier and ensure that it does not incur additional costs. On significant economic presence tax, we have talked about that increased scope. There is also an expanded definition on what qualifies for CGT exemption on transaction between family members. So now where you have a transfer to a company that is 100% owned by an individual family member and one spouse, so individual immediate family member is usually taken to be children. So if you have a company that is 100% owned by the one spouse and the children, and you make a transfer to that, that will be exempt from capital gains tax. There is a very welcome change that has come in terms of transfer pricing discussion, and this pertains to introduction of what we call advanced pricing agreements. So when it comes to advanced pricing agreements, what we are saying here is that you can prepare your transfer pricing documentation, submit it to the commissioner, have a discussion, and when the commissioner is agreeable to how you're pricing those transactions, that will be locked in for a period of 5 years, and the commissioner cannot change their stance on that. They can only come to audit whether you are carrying out your transaction in line with the agreement. So this will come into effect from 1st of January 2026, and within 6 months, the commissioner will be empowered to give further regulations, because the way it is anchored in the Finance Act, it needs to have supporting regulations to govern how those discussions will be carried out and what will be the powers of the commissioner in relation to enacting the advanced pricing arrangements. Another change that has come in, just a clarification on what we call minimum top-up tax. This is a tax that is applicable to multinational enterprises that have a consolidated turnover of more than $750 million or euros, and where they pay an effective tax rate in Kenya of less than 15%, they are supposed to top up that tax to at least 15%, and that timeline for paying that tax has been clarified to be by the end of the 4th month after the year, and basically will be payable by the same date as the balance of tax. There is also some clarification on withholding tax on qualifying dividends and payments that will be taken to be a final tax. Something else to note is that now there is clarity on membership transactions by membership clubs and trade associations, they will be liable to account for CGT on gains from transfer of qualifying transactions. Again, another clarification is that withholding tax will be applicable to non-residents with a permanent establishment in Kenya where they supply goods to a public entity. Remember, there was that introduction of withholding tax on any supply of goods by a resident person or a non-resident person to a public entity, which includes government and government agencies. Some other clarification, again, is that now diminution allowance on what we call loose tools will be applicable at the rate of 100%. Basically, we are saying that you'll be expensing the whole cost in a year of income. Donations which are made towards construction of public sport facilities on public grounds will now be a deductible expense for tax purposes. I think the most significant change that has come in through the Finance Act and which will affect so many businesses comes in the form of the limitation of what we call the carry forward of tax losses. Remember, we had that carry forward of tax losses was applicable indefinitely, but now the government has come in to cap that to 5 years, and where you are not able to carry forward or to exhaust your tax losses in 5 years, you'll be allowed to apply to the commissioner to be able to carry forward those tax losses for a further period. I think this is very significant, noting that the business environment that many people have been operating in, as well as many businesses that have investment allowances, have in place tax losses, which we always say are tax assets, which we have been carrying forward for indefinite periods, but now you'll be required to carry that forward for a period of only 5 years. What is not clear, and what we hope that the government or the commissioner will issue a public notice to provide clarity, is in effect to the prior year tax losses that were there, and when you are allowed to carry them up to what period. We expect that to be maybe provided for clarity in terms of public notice by the commissioner. In terms of tax exemption certificates, there has been an extension of timeline for issuing the tax exemption certificates to 90 days from the date of the application, possibly to provide the commissioner enough time to be able to review the application and ensure they make the correct decision. Again, what we talked about, the change of year end, where the commissioner fails to respond within now 3 months, the change will be, or the application will be deemed to have been applicable. The income of a ship owner, earlier on, the ship owner had to account for their own taxes through majorly appointing a tax representative, but in an effort to ensure that all ship owners in Kenya or who operate from Kenya are paying their fair share of taxes, the tax burden has been shifted to the person who engages the ship owner in the form of a withholding tax. So the person who engages a ship owner and you are a resident person, you'll be required to deduct and withhold tax at the rate of 2.5% and pay that to the commissioner on any income that you pay to the ship owner. There has been an effort to incentivize the Nairobi International Financial Center Authority, which was created to compete with the likes of Mauritius and other tax havens to ensure that we attract multinational enterprises and holding companies as well as startups in Nairobi, where they can be able to set up in an environment that is tax friendly, same as what they always go for out there in the tax haven. So there have been some tax incentives, some of them notably the reduced tax rate of 15% for companies that establish on the Nairobi International Financial Center Authority, as well as startups establishing under the NIFCA will enjoy a reduced tax rate of 15% for the first years of operation, which now shifts to a lower rate of 20% before they transition to the tax rate of 30%. So a very welcome move, which we hope will have a positive impact on entities that will apply under NIFCA. On employment taxation, another welcome move or a welcome change is that The tax-free per diem limit has been increased from 2,000 shillings per day to 10,000 shillings per day, of course, taking into consideration the increased cost of living. Mortgage interest on amounts borrowed for construction will now be a tax-deductible expense up to an amount of 360,000. Previously, you could only get that tax deductibility on mortgage interest on amounts used for purchase or renovation of residential property. There has been a subsequent change following the change that came in through the Tax Laws Amendment Act, where any pension withdrawals upon retirement age or gratuity or allowances that are paid under a public pension scheme are exempt from tax. There has been a clarification that to split the tax exemption and on the gratuity and other allowances to provide that any gratuity paid upon retirement will be exempt from taxation. Another change that has come in is that on spectrum license on defensible rights will enjoy a capital allowance of 10%, possibly not under employment taxation, but under under tax deductible expenses. Some other repeals that have come in through the Finance Act 2025. Earlier on, we had an exemption on the income of an unresident or an uncitizen in Kenya up to that of the year income was exempt from taxation in Kenya. That has been repealed, and now non-citizens will be taxable in Kenya on all the income that they accrue, or all the employment income that they accrue or derive from Kenya. There is the issue of gross investment receipts. I think we handled that earlier on, that all transactions towards or for membership clubs and trade associations will be now subject to tax unless they relate to membership or payments for membership joining and subscriptions. There was a change that came in through the Tax Laws Amendment Act, where there was the introduction of withholding tax on sale of scrap, but that has now been repealed. So any sale of scrap will not be subject to withholding income tax. A change that came in through the Finance Act 2023 through the introduction of the digital asset tax on cryptocurrency transaction has now been repealed. So there will no longer be a digital asset tax on cryptocurrency transactions. Some other changes that have been made relating to CBC reporting or country by country reporting is that there is no longer a requirement to appoint what we call a surrogate parent entity. So all constituent entities that are part of the group and where you've made the threshold of 96 billion shillings in a year of income, you'll all be required to abide by the country by country reporting requirements. Gains on transfer of property by a licensed developer within an SEZ will be subject to capital gains tax, as well as capital loss on disposal of property will now be subject to or will not be taken into consideration when doing your tax computation. Some notable proposals that were there in the Finance Bill 2025 but have not seen the light of day include some very punitive proposals that have been introduced. The first one being on the expansion of royalty, which was primarily saying that transactions relating to software distribution would be subject to withholding tax as a royalty. That has subsequently been dropped. The issue of digital asset tax rate reduction from 3% to 1.5% has subsequently been dropped, taking into consideration that digital asset tax has been repealed. There was a proposal to repeal the 100% and the 150% investment allowance on SEZs or special economic zones, as well as investments outside the counties of Nairobi and Mombasa. That has subsequently been repealed. And the preferential tax rate of 15% for local motor vehicle manufacturers and real estate companies involved in the construction of at least 100 residential units, that has again been dropped, and those two industries will continue to enjoy a preferential tax rate at the rate of 15%. Moving forward to the Tax Procedures Act, which is the Tax Administrative Act that covers all tax administrative issues. The changes that have come in, there is an increased scrutiny on a transaction involving exportation or importation of goods, whereby now you'll be required, where you're importing the goods, that you'll be required to provide to the commissioner a valid certificate of origin, and failure to provide that certificate of origin will be an offense that will result in the seizure or forfeiture of the goods to the commissioner or an authorized officer. And that certificate of origin will have specific items that will be included. It will have to have the exporter's name and address, the importer's name and address, port of origin, accurate description of the goods, quantity of the goods, country of origin, and the country of destination. And the import document, all your import documentation will, going forward, not be processed, and the goods will not be cleared for entry into Kenya unless that certificate of origin and the other supporting documentation have been provided. This is primarily to try and ensure that there is no tax leakage at the time of importation, and the correct declaration of the goods has been provided to the commissioner. Maybe just to note that there were some proposals in Finance Bill 2025 with relation to the Tax Procedures Act that were dropped, and notable of them was one which brought a lot of hue and cry from many taxpayers with relation to where the commissioner would have unfettered access to trade secrets and customer data, and that has subsequently been dropped. Another proposal that was there was that the Tax Procedures Amendment Act 2024 provided that when you are counting the timeline for lodging an objection on an appeal, you would not count public holidays and weekends. There was a proposal to repeal that, but that has been sustained. So when you are making your application for an objection or an appeal, when you are calculating your timeline, you will not count weekends and public holidays. Another punitive proposal that was there in the Finance Bill 2025 was that there was a proposal to provide that the commissioner may issue an agency notice to a taxpayer where the taxpayer has even lodged a notice of appeal to the Tax Appeals Tribunal or the court, unless where you go and get a stay order. I think that has faced a lot of opposition, and that proposal has now been dropped, and the commissioner cannot issue an agency notice where you have appealed against an appealable decision within the required timelines. Some items that have been retained in the Finance Bill to Finance Act 2025, albeit with a few amendments, was the issue of offset of refund of overpaid tax, where you have an approval for refund for overpaid tax. Now you can utilize it to pay against any output tax payable. Some other items that have been retained and now which have become law in relation to the Tax Procedures Act include electronic tax invoice exemptions for any payments related to emoluments, imports, payment of interest, just to ensure that all these you don't require an electronic tax invoice. Where the commissioner amends an assessment, the commissioner will be required under the Tax Procedures Act to provide a reason for the amended assessment. Now, we'll no longer see scenarios where you just wake up and find an amended assessment on your iTax ledger without any explanation of as to what informed that amendment. Another welcome change that has come in is that where you have not withheld tax on payments to a resident person, and that person goes forward and accounts for that income and pays the full tax on it, you will not be penalized for failure to deduct that withholding tax. Remember, the Tax Procedures Act provides that where you fail to withhold tax, either withholding income tax or withholding VAT, the tax will be deducted on you as if it was your tax. So there is a reprieve for that, that if the other person has accounted for that tax, there will be no longer requirement, there will be no longer a penalty on you on that tax. Another change that has come in is that when the commissioner seizes some property from you in terms of for purposes of settling any tax, especially where you have failed to offsetting or to pay any tax, the commissioner will be exempted from paying stamp duty on such transaction. There is an increased scope of agency notices to cover also non-residents where that non-resident owes you money. Remember, the commissioner is empowered to issue an agency notice to any person who owes you money, where you owe the commissioner some money such that they first pay that money to the commissioner before they offset any obligation to you. And there is a cleanup where withholding VAT penalty has been reduced from a rate of 10% to the normal late payment penalty of 5%. Some other notable changes is that the least objection on tax decision, if the commissioner allows a late objection and the decision period starts from the date that objection is lodged, and the KRA will now have an extended period to process refund applications from 90 days to 120 days, and if under audits from 120 days to 180 days. The last item on Tax Procedures Act, which we have already seen the commissioner apply it, is that where there is penalties and interest that accrue because of errors generated by an electronic tax system, like we saw on the last day of filing the tax returns, people would not be able to file tax returns and there will be penalties and interest. The commissioner has now been empowered to waive those penalties and interest because of those errors generated by the electronic tax system. I wish to pause at that and hand over back to Michael so that he can invite James for the next session.
Well, thank you very much, Kevin. That was quite insightful. And to the participants, please remember to post your questions as we go along. We are going to answer all these questions at the end. So far, we have received very interesting questions or clarifications sought. So we are going to deal with this at the end. So coming up is James Muridi, our tax director, to deal with indirect tax changes. James, up to you.
Thank you, Michael. And thank you to Alpesh as well as Kevin for very insightful presentations. So I'll just quickly go straight into the VAT amendments that were introduced by the Finance Act 2025. And you'll note, like Kevin sort of gave an introduction on these tax amendments, we're basically looking at what was previously proposed. But then remember, the finance bill was subjected to public participation, and there are those views that are normally given in that process, and you'll find that there are certain amendments that can be enacted through the Finance Act, but they were not initially part of the finance bill. And that's why we've also tried to look at sort of widen that net to show, yes, that indeed there could be some amendments that have been enacted, but that were not previously part of the finance bill. And a very notable one is the first one, where you can actually get a refund of excess input VAT that had accumulated despite having taxable supplies. And I think this I think is a common occurrence where you find that you could be having a taxpayer who has taxable supplies, but maybe by virtue of having huge capital expenditure, they end up having excess input VAT, which ordinarily is not refundable. But then you find that along the way, the VAT status of the taxable supplies changes to zero rated. And basically, if this change from taxable supplies to zero rated supply happened as from 1st July 2023, then that excess input VAT would be available for refund, provided the taxpayer makes the application within 6 months to the commissioner. So I think that is actually a very notable amendment particularly for those people who have huge input VAT credits because of capital, basically capital investments, so they incurred input VAT on machinery and the likes. Then there is another amendment where basically the VAT exemption on capital goods that was granted basically before 27th December 2024. Remember when we refer to 27th December 2024, this was the date of enactment of the Tax Laws Amendment Act of 2024. So basically that exemption on capital goods that had been granted before 27th December 2024 will be available for a period of 12 months up to 27th December 2025. Then something touching on the sort of textile industry, any imported raw materials under basically tariffs in chapters 5407 and 6309 used in textile manufacturing will now be subject to VAT at the standard rate of 16%. If we move on, basically there are certain goods that have actually been reclassified from general rate of VAT to VAT exempt, and we basically have the placebos and blinded clinical trial kits. We also have so these items were generated but now are VAT exempt. These have actually been enacted into law. Then you also have all goods that are imported or purchased locally by the Defence Forces Welfare Services are now VAT exempt. Mosquito repellent equally is VAT exempt. And you'll also notice on the next point is that any inputs, machinery or raw materials that are used in the manufacture of mosquito repellents are equally VAT exempt. The supply of any locally consumed teas is also VAT exempt from general rate. Then any taxable services that are supplied to manufacturers of mosquito repellents have equally been VAT exempt. Also another change touching on the Defence Forces Welfare Services is that any accommodation, restaurant, beauty salon and laundry services that are provided by the Defence Forces Welfare Services are equally exempt from VAT. Then we also have taxable services for direct and exclusive use of the Defence Force Welfare Services. So you can see there's a lot of focus on the Defence Forces when it comes to the exemptions. Now, as I mentioned, this class of items that have been reclassified from the general rate to VAT exempt were not previously captured in the finance bill. So these basically were enacted directly after public participation in the Finance Act of 2025. Other changes, and these are actually changes that were previously there in the Finance Bill 2025 and which were eventually enacted in the Finance Act of 2025. There's basically the issue of tax invoices, and I think the issue of tax invoices, electronic tax invoices, e-teams has been a thematic discussion when it comes to VAT. I believe we'll all interacted with the filing of VAT at the time being, and you note that the issue of auto-population of VAT returns is very critical. And you see auto-population of VAT returns only works because of enforcement of e-teams requirements, where you basically cannot be able to claim any input, for example, if that e-teams invoice has not been transmitted by the supplier. And equally, from a supplier perspective, your output VAT will equally be populated based on all the sales invoices that were transmitted. So you can actually see the emphasis on tax invoice from a VAT perspective is also to align it with the provisions of Section 23A of the Tax Procedure Act. Then something that is also very notable is a lot of emphasis and expansion of the VAT net. And we'll also see the same from an excise duty point of view when it comes to any services that are being supplied over the internet, over an electronic network, or through a digital marketplace. So you'll actually notice that there is sort of a widening of the scope in the sense that the place of supply of services made in Kenya will include any internet services that are delivered to a person in Kenya. So what basically is happening is, despite the place of supply of that service being either in Kenya or outside Kenya, the user of that digital service will determine the place of supply, which is actually quite a huge sort of paradigm shift from how place of supply provisions have been applied in the past. Then basically there is clarity in terms of the timeline for making VAT refund applications, and that should be within 12 months. So basically, if you have any excess input VAT and you need to make refund application by virtue of having excess input because of zero-rated sales, with VAT withholding credits, then you have to do that within 12 months, as opposed to the previous 24 months. Then in terms of VAT refunds on bad debts, remember you could only make the application if one of the conditions was that the debt had been outstanding for a period of at least 3 years from the date of supply. That period has been shortened from 3 years to 2 years from the date of supply. And so basically, for you to qualify for VAT refunds on bad debts, you basically have to look at what happens earlier, and that is basically the debt being outstanding for a period of 2 years from the date of supply, or basically the debtor or the customer being placed under receivership or basically under administration. So you don't have to wait until that debtor is declared insolvent. But I think practically, for those of us who actually tried to make refund applications on bad debts, particularly on the basically the supermarket chains that have gone under over the past couple of years, we can actually see in terms of practical application of this provision, it has not been working, which is quite unfortunate, despite the law being amended actually around 2-3 years ago to basically shorten that window and the criteria of basically qualifying for these exemptions. Then it is actually mandatory to issue a tax invoice if you're a VAT registered person, whether the supply you are making is a taxable supply or a VAT exempt supply. So raising of an ETIMS compliant invoice by a VAT registered person is mandatory. And additionally to that, the issue of raising ETIMS compliant invoices is only not restricted to VAT registered persons. Remember, from an income tax perspective, there's also a requirement that under Section 16 that you can only claim an expense if it is supported by an ETIMS invoice. And that was basically effective from the year of income commencing 1st January 2024. And then basically a test that even as we were doing during the audit was to try and get some level of satisfaction that our clients are actually claiming expenses that are supported by ETIMS invoices. But it's also important to note that the only expenses that are exempt from being supported by ETIMS compliant invoices, you have salaries or emoluments, you have imports, you have interest payments or expenses, you have investment allowances, and you also have any payments that are subject to withholding tax as final tax. If we move along, then you have a very funny amendment that came through where VAT will be imposed if there is a misuse of exempt or zero-rated supplies. So assuming you deal with a category of goods that are either zero-rated or VAT exempt, and you misuse them in terms of their application, then you will be required to actually account for the output VAT on the same. As to how KRA will be able to determine misuse or what the threshold is something that we're afraid could be subject to a lot of abuse. Then when it comes to any supplies that are made to official aid funded projects, and official aid funded projects are normally defined in law, you find that these supplies are considered to be VAT exempt. And you find one of the things that are excluded from the VAT exemption, if supplied to officially funded projects, we have motor vehicles. But then you find that let me call them the inputs that go towards the working of the motor vehicles, have equally been enjoying exemption. So what has happened is just to align, because any motor vehicles that are supplied to officially funded projects do not enjoy the exemption. Similarly, any fuel that is consumed on those motor vehicles, any lubricants and tires that are supplied, basically to officially funded projects, will not get the VAT exemption, so will be vatable. Then something that maybe speaks towards the extractive sector in Kenya, because I think there's been a lot of quiet times when it comes to basically the conversation and the stories we are hearing about oil and all that. So the VAT exemption that used to exist on any taxable goods, excluding motor vehicles, that are either imported or purchased locally for direct and exclusive use in geothermal, oil, or mining, prospecting, or exploration, that VAT exemption has been done away with. So basically that means any such goods that are supplied, VAT will have to be charged at the standard rate of 16%. However, if any exemption had been obtained before this amendment, that basically these are transition clause, that the VAT exemption on such goods will only apply until the 30th of June 2026, so a 1-year transition period. Similarly, for discs, tapes, solid state non-volatile storage devices used in the health sector, similarly used to enjoy VAT exemption, that has been done away with. So they'll be subject to VAT at the rate of 16%. And there is a similar transition provision for these discs and tapes, where any VAT exemption that had been granted prior to this change will continue to apply for a period of 1 year, up to 30th of June 2026. Then packaging materials for tea and coffee are now zero rated upon recommendation by the CS in charge of agriculture. Previously, the finance bill, the proposal was to actually VAT exempt these packaging materials, and I think there was a lot of submissions that were done towards this because of the impact that the VAT exemption would have in terms of the pricing of the final products. Then changes that were dropped, basically in the Finance Act 2023, basically VAT withholding credits. There was a proposal that the VAT withholding credits would only be utilized against VAT liabilities. That was dropped. So basically, any VAT withholding credits can be used against to offset against any other tax liabilities, not only VAT liabilities. Then you will notice that there was a huge raft of a lot of VAT exempt supplies that had been proposed to be reclassified to basically taxable supplies at the standard rate of 16%. And basically this whole list shows that. I will focus on, I think, the issue of I think the aviation sector. There was a proposal that all goods and parts of Chapter 88, including aircraft, that were exempt should be made taxable at the rate of 16%. We also had goods that are used in the construction of approved tourism facilities. Alpesh spoke about Kenya sort of losing the edge to our neighbors Tanzania in the tourism sector, and you see that if that proposal went through, then it would have a further effect on that. Then there is the issue of any goods that are used in the construction and equipping of approved specialized hospitals. There was a proposal to make them taxable at 16%. You can imagine the escalation in prices and the impact that would have to the healthcare sector. Similarly, specially designed, locally assembled tour vehicles that are normally VAT exempt before clearance to customs were proposed to be made vatable. There was also something very interesting about affordable housing. Currently, any goods that are imported or purchased locally for direct use in the construction of affordable housing, VAT exempt. There was a proposal to make them taxable. You could imagine what then that would be in terms of the costs. So you can actually see the raft of all these changes that were previously proposed to be VAT exempt. That were VAT exempt, and they were proposed to be made taxable, subject to VAT at the rate of 16%. That was dropped. And what actually informed that initial proposal was something that this budget and this finance bill, Finance Act was trying to achieve, was to reduce tax expenditure. So you can actually imagine the impact of doing away with all these VAT exemptions, what it would have in terms of just raising additional revenues for government. Then there were certain zero-rated supplies that were proposed to be VAT exempt in the finance bill. A majority of these proposals touch on e-mobility. So the supply of electric bicycles, the supply of solar and lithium batteries, the supply of electric buses, bioethanol vapor stores, the supply of motorcycles with electric motors, the supply of locally assembled and manufactured mobile phones that were zero rated. There was a proposal to make them VAT exempt. I think that was entirely dropped, obviously, just in line with just trying to promote sort of renewable energy initiatives. The issue of transportation of sugarcane from farms to milling factories equally had been proposed to be VAT exempt. The zero rating status has been maintained. Inputs or raw materials that are used in the manufacture of animal feeds, the zero rating has equally been maintained, as well as any inputs and raw materials that are supplied to pharmaceutical manufacturers in Kenya for manufacturing medicaments. I think that zero rating status has equally been maintained. Now, if we move to an excise duty point of view, from a definitions point of view, I think it's just more of a clarification when it comes to digital lenders, because there's been a lot of confusion and a lot of uneven playing fields when it comes to the applicability of excise duty on any fees that are charged by digital lenders. So I think there was just a clarification to properly categorize any financial institutions that are either licensed as banks, SACCOs, or microfinance institutions, and those are automatically liable to excise duty on any fees other than interest that is charged on lending. For digital lenders, there was also equal clarification that fees charged by digital lenders would be the fee component or other charges excluding interest. There used to be a lot of confusion on the issue of digital lenders and their basically qualification for excise duty. Then, like I previously mentioned, from a VAT perspective, there's actually a lot of focus to widen the VAT scope on any services that are being provided over the internet, electronic network, or a digital marketplace. And similarly, you will notice that the applicability is the introduction of excise duty on services that are offered through a digital marketplace. And it also now covers any non-resident persons who are providing excisable services to users in Kenya. So there's just that emphasis to widen the scope. There's also an introduction of who a microdistiller is, basically from an alcoholic beverages manufacturing point of view, and which is basically just to make sure that all such manufacturers are within the VAT scope. I think I'll not belabor on the last bullet on that slide, because it's just an effort to extend or expand basically any transactions that are subject to excise duty from an sort of electronic digital economy point of view. Then equally, I think I've mentioned the first bullet on the expansion of the applicability of excise duty to include non-residents where such services are consumed in Kenya through the internet. I think that I've already previously mentioned. If you look at the Excise Duty Act, particularly the first schedule and the second schedule, where the first schedule lists all the goods that are subject, as well as all the services that are subject to excise duty, you'll always notice that the Excise Duty Act makes reference to certain tariff codes. So the clarification is that the tariff codes that are mentioned in the respective schedules in the Excise Duty Act will basically be as they are set out in Annex 1 to the protocol of the establishment of the East African Community Customs Union, and the interpreting an annex, and basically the general rules of interpretation. So basically we'll be guided by the HS codes that are there in the ESC Common External Tariff Book. Certain items that were previously subject to excise duty, where excise duty is no longer applicable, you have imported eggs of tariff heading 0407. You have imported onions of tariff heading 0703. And equally, you have imported potatoes, potato crisps, and potato chips of tariff heading 0701. Other items that have either had excise duty removed or have been subject to the exemption. The reason I'm sort of trying to separate is that exemption from excise duty is provided under the second schedule. And when I say excise duty has been removed, you're basically saying an item that had previously been listed in the first schedule has been deleted. And maybe notable amendments is the issue of cosmetics. So maybe some good news to beautiful ladies. It might be cheaper to get cosmetics. I don't know if there are men who are also fans of cosmetic products. Maybe Michael can confirm to us later. Then we also have basically all goods, including materials that are supplied for official use by the Defense Forces, welfare services, as well as all goods imported or purchased locally by the Defense Welfare Forces. You can actually see there's a lot of focus on that, as well as any excisable services that are supplied to the Kenya Defense Forces Welfare Services. Then something very notable to the manufacturers of articles of plastic. If there is one amendment that has always featured every budget cycle, is the applicability of excise duty on articles of plastic. This year it was actually funny that the finance bill did not have any proposed amendment touching on that, but come the Finance Act 2025, there was actually a clarification. And what was introduced was excise duty is only applicable on imported articles of plastic of tariff 3923.30.00. So in essence, what that means that any local manufacturer of articles of plastics of tariff 3923.30.00 is no longer subject to excise duty. Now, the next couple of slides have tables with items where excise duty has either been introduced or the excise duty rate has been increased. For the sake of this presentation, I do not want to per se read verbatim each and every item, but generally, it is important to note that if you deal with either of the following products that have the following descriptions, either imported float glass and surface ground or polished glass, imported paper or paperboard. The reason I'm just giving the general product descriptions is so that maybe after today's session and after you receive our detailed tax alert, you can clearly check if there has been any amendment to the excise duty rate of the particular products that you deal with. In this session, I don't believe we can exhaustively look at each and every item, given the time that we have. Then we also have products with the description printed self-adhesive paper. You have imported other self-adhesive plates, imported printed polymers of ethylene or of other plates. So it is important, and you'll notice that when it comes to excise duty, as well as VAT, and as well as customs, you'll notice that the product description is very important. You will note that a majority of these items, even the ones on the table that is currently on this slide, the reason under the column previous rate, we've indicated it's not applicable, is because that item, if you go to the Excise Duty Act prior to the amendment, was actually not listed as an excisable product. So it is very important to understand the exact description of the product and the HS code that that particular product has in order to determine the correct excise duty rate. So similarly, on the next table on this basically slide, same thing. It's important if you are in the space dealing with imported cartons or boxes and cases of corrugated paper. So it's important you really understand the description of your product to be able to determine if there have been any effects from an excise duty perspective. So you can actually see there's a lot of emphasis on paper and paper products. There's a lot of emphasis on as well as glass. So you can see there is imported glass of tariff heading 7003. There is imported safety glass of tariff number 7007. So you can actually see the variation in terms of the product descriptions that needs to be checked. For those in the gaming and betting industry, there has been changes. The excise duty rates have actually been reduced, I would say substantially, from the 15% rate to 5%. So for example, for excise duty on betting at 5% on the amounts deposited in a customer's betting wallet, but that is not applicable to horse racing. Then 5% similarly on gaming, 5% on prize competition, 5% on lottery, excluding charitable lotteries, and basically virtual asset transactions at 10%. Previously for that, basically for the virtual asset transactions, there was no excise duty rate. So you can actually see, I think from a betting sector perspective, there has been changes. From a Miscellaneous Fees and Levies Act perspective, you'll notice that the Miscellaneous Fees and Levies Act appeared to be like a standalone act, in as much as when we talk of the applicability of import declaration fees, when we talk about the applicability of railway development levy, when we talk about the applicability of export promotion and investment levy, you found that if there were any issues pertaining to refunds, pertaining to disputes, pertaining to appeals, that the Miscellaneous Fees and Levies Act did not seem to have any legal provision or was not even anchored on the Tax Procedures Act in terms of those issues. And the only issue that was covered in the Miscellaneous Fees and Levies Act from a Tax Procedures Act perspective was the issue of refunds of any overpaid IBF and RBL fees and that are covered under Section 47 of the Tax Procedures Act. So what has basically happened is that, which is actually a very welcome amendment, is that from a tax administrative point of view, that the administration of all the fees and levies imposed under the Miscellaneous Fees and Levies Act will basically be in line with the provisions of the Tax Procedures Act. Then, with regards to the IDF, the import declaration fee that is levied on importation of items and goods and various goods in Kenya, it's about the administration of the IDF fund that is actually mandated to cover African Union and international obligations. And it's normally at current, previously it was at 10% of the entire IPF collected. They've actually amended to increase that to 20% of the IPF collected, and the additional 10% is basically to cover for revenue enforcement initiatives. Then from the VAT presentation, we went through a lot of VAT exemptions that have come in for mosquito repellents and the manufacturing of the same. Similarly, there is an expansion of IDF and RDL exemptions on inputs, raw materials, and machinery used in the manufacture of mosquito repellents, upon recommendation by the CS. I think prior to this amendment, it was only the raw materials that were exempt. Then there is the introduction of IDF and RDL. Remember, from a VAT perspective, the VAT exemption that was there on goods of Chapter 5407 and 6309, basically touching on textile industry, have been made vatable. Similarly, from an IDF and RDL perspective, the exemption that used to be there as an exemption on RDL and IDF on these products has been introduced. Then, if we move on, I think one of the very sort of controversial amendments that came through around 2 years ago was the issue of export and investment promotion levy. There are additional items that have now been subjected to the export and investment promotion levy. And you'll notice that a lot of steel products are featured in this list that were previously not there. You'll notice the issue of ceramic flags and paving. So the issue of these tiles that are used to basically during construction of premises. There's a proposal to introduce the EIPN at the rate of 3% on the customs value, and that only speaks towards the cost, the increased cost of importation of these items. Similarly to ceramic sinks, wash basins and wash basin pedestals. So basically, these items that are used in toiletry items. Similarly, I've mentioned the issue of introduction of the levy, and you can actually see it's at a very high rate. For example, for the last two items, at the rate of 17.5% of the customs value, you can see it's on iron and non-alloy steel in ingots or other primary forms, and other alloy steel in ingots and other primary forms. And if you move along, you can actually see more steel and iron products that have been affected, semi-finished products of iron or non-alloy steel. The rates, you can actually see the rates are quite high, 17.5% of customs value. If we move to the next slide, in terms of the proposals that were brought, there was actually a proposal to reduce the levy, the export promotion and investment levy on certain iron and steel products from 17.5% to 10%. Those were dropped. So you can actually see that the levy is actually quite steep for the iron, steel, and basically bar sector. Then the IDF and RDL exemptions that were there on specific aircraft of Chapter 88, as well as all goods and parts of Chapter 88. There was actually a proposal to do away with these exemptions, and basically that proposal to repeal this exemption was dropped. So it basically means all goods and parts of Chapter 88 still remain as exempt from IDF and RDL. From a stamp duty act perspective, a very welcome amendment, and it's basically the waiver of stamp duty on transfer of property by companies to shareholders as part of internal restructuring. And I think this is a very welcome provision, because you find the only stamp duty exemptions that are there under Section 96 of the Stamp Duty Act cover scenarios where it is a transfer of property that is subject to stamp duty, where the transfer is to a company that owns more than 90%, or within a group or within companies that are held by a third company in that group that owns more than 90%. And this proposal is actually a very welcome proposal, because then it really cushions property transfer transactions from a stamp duty point of view, where the properties are simply being transferred by companies to their ultimate shareholders. So I think that is a very welcome provision, and that is sort of in tandem with the capital gains tax exemptions and paragraph 13 of the 8th schedule. But then we are hoping that we will not face similar challenges that we face when it comes to securing capital gains tax exemptions on transactions that are necessitated by internal restructuring. We are hoping that we will not face similar constraints as the ones that are there from a capital gains tax perspective when it comes to this stamp duty exemption on such transfers within groups that are internally reorganizing. So thank you so much for your time. That brings me to the end of my presentation, and I'll take this opportunity to hand it over back to Michael.
Thank you, James. I think the three gentlemen have done a very good job this morning. Very detailed, precise, and concise presentations. You will agree with me that what we have covered in 2 hours require quite, more time in terms of really delving into the details. And therefore, after this, we are going to send to you our tax alert, which is going to be detailed. But more importantly, we remain here and working for you to always get in touch with any of our team members or any of your regular contacts at PKF for any further clarifications. As you well know, tax matters can be sort of like sometimes require interpretation. So it's not possible to probably break down in detail everything in this presentation. So thank you to the three gentlemen, James, Alpesh, and Kevin. And I think because our managing partner is listening behind the scenes, these three gentlemen deserve lunch. And in any case, as you well now know, the per diem is up to 10,000 shillings from 2,000, so you don't have to account for it, Ritesh. I'll go straight to the questions. I'll pick a few of the questions that you have sent across, and the three gentlemen will try to answer them to the best that they can at this point in time. And the first question is to you, Alpesh. And this question is from someone who says that India increased the threshold for taxation for individuals to $14,800 per annum. Approximately that is 2 million Kenya shillings per annum. That's about 160,000 Kenya shillings per month. That for personal taxes, anybody earning about 160,000 shillings per month is not subject to tax. This happened last year, and the purpose was to spur growth. And the question they are asking, from an economic perspective, do you think this is something that the Kenyan government ought to consider, given that I think our threshold is 24,000 shillings? So 24,000 shillings in Kenya vis-a-vis 160,000 shillings in India. What are your comments on this?
I think it's a good question. As I said, an economy is grown by its people. And when you look at the developed nations, and even if you look at India as well, I think we need to improve the middle income. And as I said, people will only spend if they have money in their pockets. They only buy cars, won't buy property, if they want to go out to eat at restaurants. If you don't have money in your pocket, how are you going to spend that money? How a business is going to grow? And how do we also bring in foreign direct investment? Because at the end of the day, when you bring in foreign direct investment, investors are looking at making money. There is no point in giving investors tax incentives. What they're looking for is their purchasing power in Kenya. I think there were records, I think about 50 to 55% of Kenya's population lives on less than $1 a day. Which is quite concerning, which is quite inequitable. So we don't really have a middle class. And I think the approach, what India have done is trying to improve the consumer spending, trying to collect more tax from corporate taxes rather than collecting more tax from PAYE. So that improves the economy. People feel like investing. People feel like investing more into other cities as well. I think that's an approach which Kenyan government needs to look at very, very critically. We are all aware that our highest tax rate is now going to 35%. Technically, if you take shift and you take housing, maybe we are paying almost 40%. And that's not the way to go. I think we need to seriously look into this, and probably it should have been a good idea to see how we could increase our banks and leave some money for the local one NG to spend more money and to increase economic activity.
Thank you, Alpesh. The next question is still to you, Alpesh, and is on debt sustainability. You talked about as almost now, every year we are raising up the ceiling on our debt. And the question is that the taxes are not performing very well, and the government has to function. So what is the alternative to debt?
I think the alternative is if I was just working out in my mind is if they could bring in at least a 5% efficiency on their spending itself, right? Just a 5% a year, about 4.2 trillion. 10% would be about 420 billion. Just a 5% is almost 240 billion. If they can increase that to, let's say, 10% and try and see how they can get a balanced budget. And as I mentioned when I was speaking earlier, what our Honorable Minister said is we're not looking at revenue collection. We know what we can collect, but we now need to look at what we can spend. They've talked about zero-based budgeting, whether we can have a balanced budget, how we can sustain our fiscal deficit. Because running your government and paying 13 to 14% at times at 18% interest is next to impossible. And as you've seen from my numbers, we're spending 1.3 trillion in just servicing debt interest. Forget about the debt repayment, just interest alone. And then you're spending another 550 to 600 billion shillings on education, where we can't get employment and we're exporting our talent. So I think it's a great concern. I think efficiency is one side. A second issue is in time to come, if the debt is still increasing, we need to probably look at debt relief to some of the countries and see how we can manage our debt sustainability. Because we cannot continue to add 600 to 700 billion on our debt without really growing our economy. And I think they need to really focus and see what is Kenya good at, what can we grow. We have looked at tourism, how can we help our exporters? Why should people wait for VAT refund for 9 to 12 months when they're exporting goods to other countries, creating employment, especially on the farming side, between 2,000 to 3,000 employees paying PAY, paying corporation tax, bringing in foreign exchange? Why should such people be waiting 9 to 12 months for the VAT refunds? We need to look at those kind of situations so that we can bring in foreign direct investment, grow our economy, collect good taxes, and try and reduce our debt time to come.
Thank you, Alpesh, for that. And the next set of questions, Kevin, are directed to you. And the first question is on electronic tax invoicing. And the question is, should we have a threshold on the amounts that will require e-teams as opposed to every single invoice, including, very small purchases from the supermarkets, from the transport sector, from petroleum sector, for fueling cars and all that. And the question is, does this not create an administrative burden for purposes of ease of people accounting for their taxes? What are your thoughts, Kevin, on this?
Thank you, Michael, and thank you to the participant who has asked that question, because it's a very legit question. Actually, interacting with the report of the Finance and National Planning Committee on Finance Bill 2025, that issue featured prominently. And I concur with what the participant is putting. One of the canons of taxation is that it should be very easy to administer. And in part of the administration, we should have thresholds that ensure that we are not making the tax very hard to administer on very small transactions. I'm talking about it and aligning with what the participant has asked. We need to have a materiality threshold in terms of complying with some of these transactions. It is not necessarily for purposes of avoidance of tax, it's just for purposes of ensuring that we are not dedicating resources to transactions that are not really material. So yeah, I agree. It would go a long way in helping maybe small businesses, encourage them so that in time to come, they will be at a position where even the costs of complying is commensurate to the value that they are getting, as well as the cost for the government to roll out some of these systems. So yeah, there needs to be a materiality threshold in terms of complying with electronic tax invoicing system.
Thank you, Kevin. I think the next question is to you, is on advanced pricing agreements with the Kenya Revenue Authority for purposes of transfer pricing. And the participant's concern is that, and just to quote the participant, is that the Kenya Revenue Authority are known to be very notorious in terms of not respecting their private rulings or the positions that they have taken against taxpayers. And the taxpayer is concerned. What is going to be put in place to ensure that the APAs are respected by the Kenya Revenue Authority?
Thank you for that question as well. Very genuine concern. When we were making our submissions to the committee, it's one of the positions we put forward that there needs to be regulations to provide for the administration of APAs, because be as it is, it will be subject to a lot of misuse and onerous audit by the Kenya Revenue Authority. As the change has come, it's a very welcome proposal, because one of the things that it will ensure is certainty in terms of taxpayers who have transactions with related non-resident entities. But at the same time, there needs to be controls to be put in place. And what now the Act has provided is that with the introduction of APAs, the Commissioner has been given 6 months to provide and to issue guidelines. I think it's something we'll be on the lookout for when those guidelines are provided for public participation, so that we ensure that those guidelines provide very strict conditions to be met, not only by the taxpayer, but also by the Commissioner, to ensure that APAs themselves serve the purpose which they are intended for. I think what that participant is alluding to is where we have seen the Kenya Revenue Authority give private rulings, and when they come for audit, they go against the same rulings they have given. I think it's something we are going to advocate so much for, that because APAs will be applicable for a period of 5 years. Within those 5 years, the Commissioner cannot change their stance on what they say that this is the best way to price your related party transaction. There needs to be that covenant that will be binding between the Commissioner and the taxpayer, that what has been agreed and has been put in writing cannot be changed unless the Commissioner comes to audit that the transactions are being undertaken. So I think at this point, the changes it has come, it needs the regulations, and we will be on the lookout for those regulations and provide our voices and our remarks to it to ensure that the envisaged goal of APAs has been met, and APAs will not be used by the Commissioner as a means of maybe targeting certain taxpayers.
Thank you, Kevin. And maybe to add my thoughts on the same and to give comfort on that particular question is that recently, or in the past years, the courts of law have actually weighed in on this matter and made sure that the rule of estoppel, that where Kenya Revenue Authority have sort of like legitimately given an expectation on a certain matter, that has been enforced by the courts of law, and the KRA cannot walk out of that. Additionally, also in making the regulations that they have been asked to make or to publish, they must do that within the confines of the spirit of why this change is coming in, and also to specify or to say that the Kenya Revenue Authority's work as an agent of collecting taxes is not to actually make laws, is to implement the laws made by Parliament, and therefore they have no authority to sort of like disregard. And we have seen in many cases in the past, the courts of law have actually weighed in on this matter and forced the KRA to leave by their rulings. Last question to you, Kevin, is on exemptions on gratuity, and the question is whether this will also work where an employee has not reached the retirement age, but is probably shifting to a new employer. Your immediate thoughts on this, and if you don't have any immediate thoughts to that particular participants, you can always follow with an email and we'll come back to you, but you can.
Okay, thank you, Michael. I think if there's one area that has we have gotten even many questions, even on our day-to-days on the issue of tax exemption on pension. Remember, this came in through the Tax Laws Amendment Act that was enacted on December 20 and became effective from December 27, 2024. And I think a strict interpretation of how that provision is provided is that the first exemption is that where you make any pension withdrawals upon attainment of the retirement age set out by either the National Social Security Fund, NSSF, a registered pension scheme, a registered provident fund, or any other form of registered retirement fund, then those withdrawals will be exempt from tax. Subsequently, the provision provides that this exemption shall also be applicable to payment of gratuity. Now that has been separated, gratuity, and now payments out of other payments out of a registered pension scheme. So a strict interpretation of that shows that that exemption is to be applicable upon attainment of retirement age for gratuity. I know where that question is coming because there are other conditions that are provided where pension withdrawals may be exempt from tax. Notable ones being where you have made contribution for a period of more than 20 years to a registered pension scheme, pension fund, or the NSSF, and you make withdrawals, or where you make a withdrawal upon early retirement because of health reasons, you will be exempted from tax. But I think how the wording of the provision is the first schedule of the income tax is that what will be exempt in terms of gratuity is gratuity paid upon retirement.
Thank you for that, Kevin. And the next set of questions is to you, James. And the question here is on, claiming VAT refunds on bad debts. And the time limit has now been adjusted to between 2 and 10 years. Previously, it was, I think, 3 to 5 years. The question is for you to expound a little more how this is going to work.
Yes, so thank you, Michael, and thank you for the question. So in essence, the way it should work is the timelines that Michael has indicated, previously 3 years, that has now moved to 2 years. And the 10 years, maybe if I can just explain the operation of those years, is any refund, VAT refund application on bad debts. And remember, when we say VAT refund application on bad debts, we are basically referring to the output VAT that the supplier had to pay, but has not received payment from the customer. So in essence, the supplier ended up incurring the output VAT and has not received payment from the from their customer. So we're saying that basically that debt has gone bad, and that's why the supplier is seeking a reprieve. And that's why, just to conceptualize it and to put it into context, is I mentioned the issue of the retail supermarkets that have gone under, and you can imagine the number of businesses that had actually supplied products to those supermarket chains. You have to account for the output, but you've not been paid. It's been more than 10 years that the supermarket chain went down. So what is really the reprieve? And this is the provision that we're discussing. Now, the 10-year window is for you to make that application, you must make it within 10 years from when you made the supply. That is like any application that is made after 10 years is considered to be time barred. So 10 years is the maximum window. You have to make sure that you make the refund application. But then you don't just wake up today and say, I've made a supply, and within a week, a month, you start making, you have not been paid, within a year, you've not been paid, and you start making a VAT refund application on bad debts. You have to wait for 2 years from when you made the supply. So 2 years have lapsed, you've not received payment, you are actually accounted for your output. That is like the earliest you can start by making the application, but you can wait until 10 years up to the maximum. But even with the 2-year window from the time of making supply, there is another condition. If you look at the law, it talks of basically that debt has been outstanding for a period of at least 2 years from the date of supply, or the customer has basically been is under administration, is under statutory management. So what actually happened when the 3-year period came in and it was extended even further to 10 years, is that they also lowered the threshold of the customer being deemed to be insolvent. Because what it used to read, and which is sort of the same interpretation that is taken from the commissioner's guidelines from an income tax perspective, and that is what sort of KRA have also been clinging on for anyone who has made a VAT refund application on bad debts, is that the basically the customer must be considered to be insolvent, and there has to be a court ruling to that effect, and that's what has really been delaying this. So basically the expectation is, given the provisions of lessening the time from supply to 2 years, having up to 10 years to make the application, and also having the window that it is not necessarily that the customer must be declared insolvent, provided they're under some form of an administration or statutory management, it allows you to make the application. From a VAT perspective, there should be no hindrances, and the KRA should not be tying that to the commissioner's guidelines. So that's really the challenge in terms of the realization of that provision, but also just to give further explanation on what that provision entails.
Thank you, James. One last question for you is on issuance of credit notes. The time limitation of 6 months, and the participant is worried about whether that timeline is sufficient. For certain businesses, there are long operating cycles, and therefore there's a suggestion that perhaps we should consider having Parliament increase that to 12 months. What's your view, James, on this?
Yeah, I think a good question, and I think the rollout of VTs, the population of VAT returns has made that 6-month period of raising credit notes become live, because right now automatically, if you try and raise a credit note beyond the 6 months, you will not be able to do it, and it will not be it will not be transmitted through VTs. So that will not allow. Unfortunately, the law has prescribed that time of the 6 months of being able to raise credit notes. There's nothing we can do right now. I think the government and KRA has been enabled by having automated systems, whether it's e-Teams, iTax, that will clearly check the dates and automatically put the guard down to make sure that you cannot raise a credit note beyond the 6 months. So unfortunately, for the time being, we just have to contend with that. Maybe in the next budget cycle, submissions can be made to give consideration to those businesses that have longer business cycles. A majority of these issues also come up because of contractual disputes or breach of contract, where you are forced to raise the credit note beyond the 6 months. So I think there needs to be submissions or some lobbying around towards extending that time, obviously to give consideration to businesses with different business cycles.
Thank you, James. And well, lest I was not a presenter, someone has very specifically asked me to indulge on a certain question, which is KRA's legacy notices that are going back to the 1990s. And they have asked me to say, what's my view on this? You all know that in the last 1.5 years or so, the KRA have visited a ghost known as Legacy. Legacy was the operating system before iTax. And before that, of course, there was the ITMS and other systems, and the manual system as well. 1990s were manual systems. So where they have sent, notices to taxpayers to reconcile accounts dating back to 1990s. I'm not sure if the presenter on my left, Kevin, was born in that year, but yes, that's the really tragedy, because when you ask someone to reconcile their books, their tax affairs, and in fact even issued demand notices, to me is a flagrant violation of the law as it is. Remember, there is the statutory limits or timelines within which the Kenya Revenue Authority can query your tax affairs, and that is now clearly marked as 5 years in the Tax Procedures Act. And the courts of law have actually weighed in where the Kenya Revenue Authority go beyond 5 years to actually stop them from pursuing any taxes. When this thing came, I think last year, the issue of legacy taxes was a good idea by the Kenya Revenue Authority for people to clean up the tax accounts, where especially people on unpaid taxes, but not querying new tax, demands or taxes or assessments that were not dealt with at the time. So my view remains the same. It has not changed, that anything beyond 5 years is unprocedural, is illegal, and the KRA is actually participating or dwelling in an illegality. And where they pursue you on that basis, two options have been put on the table previously, that rather than to fight with an authority which has got resources to fight with you, where you felt that you are convinced that some of the legacy taxes were payable, you proceed and do it. But where you feel that it is not possible to get the documentation, or it is unreasonable for them to query those taxes, then you are perfectly within the law to object or to go to court to stop them from pursuing those. So those would be my views. It's a very controversial subject, and I think what I have seen over the last couple of months is that the KRA are not very keen where you protest to pursue the matter. So that should remain that way, and I think anybody who is facing such difficulties, you can engage with us so that we can, make for you a very, tailor-made approach to dealing with this. The last question I had was from our presenter, and James posed a question to me and to comment on behalf of the men in this discussion, whether we are happy about cosmetic products being exempted from excise duty. And my answer, James, to you is that unfortunately, I am a member of Joint Cheke, where I come from, and I'm not therefore around to comment on those matters in public. So that question will remain unanswered for today. To all the participants this morning, thank you very much for joining us. As I said, we are going to be circulating our tax alert, which is quite detailed. That may probably not answer every question that you have. The panel here or your usual contacts in PKF remain available to support you as always, and we are happy to receive very tailor-made or very specific queries in respect of your businesses. We'll be more than happy to support you. Thank you very much to the participants again for making this happen, and also behind the scenes, the whole team that is supporting us to make this possible. Thank you to you for working through the demonstrations yesterday to make sure that we don't push this agenda to next week. So thank you very much, and may you have a good day.